All right, let's talk about American Healthcare REIT, or AHR. They just dropped their latest earnings report, and if you only looked at the headlines, you'd probably think, uh-oh, bad news. But stick with me here, because when you dig just a little bit deeper, you find this really fascinating, kind of confusing story.
And that's the big question we're tackling today, right? How on earth can a company miss expectations, but at the same time actually be winning? It feels like a paradox. So let's see if we can unravel this thing together.
So here's what everyone saw first. On February 26th, the Q4 numbers hit the wire. And boom, the first thing that jumps out is a big miss on earnings per share. We're talking 40 cents below what the analysts were predicting. Yeah, not exactly the start you want to see. And it wasn't just that. The bad news kept coming. They also missed on revenue by more than $13 million. So you can see why, if you were just scrolling through the headlines, you'd think, wow, AHR is in trouble. Two big misses. It looks pretty bad on the surface.
Okay, so that's the confusing picture the headlines painted for Q4. But like I said, the real story, it's hidden just beneath all that noise.
Which brings us to the real performance metric. See, this is the key. For a special kind of company like AHR, you can't just look at the usual numbers. They don't tell you what's really going on. You've got to know where the true story is. And to get that, you first have to know that AHR is what's called a REIT, a real estate investment trust. Just think of it this way. Their whole business is owning and operating buildings that make money. In their case, it's healthcare facilities. And because their business is so different, we have to look at them differently too. And this is the secret weapon, the most important number for our story today. It's called same-store net operating income, or just NOI for short. Basically, it's a way to check the health of the business by only looking at the properties they've owned for a while. It cuts out all the noise from new purchases or sales. It's the real, honest-to-goodness health check. And here it is. This is the big reveal. While the headlines were screaming about misses, AHR's actual core business was, well, it was on fire. Their same-store NOI grew by a huge 11.8% in just the fourth quarter. And for the whole year, a whopping 14.2%. I mean, these are just fantastic numbers. And get this. This isn't some one-time fluke. It's a trend. This is the second year in a row that AHR has posted double-digit growth in this key metric. That tells you something powerful is happening here. That's real consistency. So let's meet the growth engines, shall we? I mean, a 14% growth rate is incredible, but where is it coming from? Let's pop the hood and see which parts of the business are really firing on all cylinders. Okay, check this out. It turns out that the lion's share of their income, we're talking almost 77%, comes from just two parts of the business. You've got their integrated senior health campuses, which are run by a partner called Trilogy, and their senior housing operating properties, or SHOP. These two right here, they're the powerhouses. And would you just look at the performance of those two powerhouses? It's absolutely nuts. The SHOP segment grew by more than 25% year over year, and Trilogy wasn't slacking either, with over 18% growth. I mean, they are just blowing the doors off the overall average. So you're probably asking, how? How are they doing this? Well, it's not magic. It's just really, really smart management. They're filling up their buildings. Occupancy is getting close to 90%. They're being smart about pricing, they're keeping a tight lid on costs, and, this is key, they're bringing in more residents with better-paying Medicare plans. It's just a textbook example of running a business well. All right, so they're buying for the future. You know, a company that's this strong isn't just going to sit back and count its money. No way. They're using that momentum to get ready for what's next. Let's take a look at their aggressive game plan from 2025. And when I say aggressive, I mean it. In 2025 alone, they spent $950 million on new properties. That is a massive number. This isn't a team playing defense, trying to hold on. This is pure offense. They are pushing forward and expanding their territory. But here's the thing. They're not just throwing money around. Their strategy is incredibly smart. They use their network of relationships to find the best deals. They're targeting newer buildings that can offer more advanced and profitable care. And they work with partners they already know are top-notch. Every move is about finding properties that will grow steadily for years to come. And believe me, this train is not slowing down. They've already got another $230+ million in deals lined up and ready to go. It just goes to show you this aggressive growth plan, it's full steam ahead. Okay, so let's talk about their 2026 outlook. We've peeled back the layers on those confusing headlines, we've seen the incredible performance under the surface, and we've looked at their game plan for growth. Now let's tie it all together and see what they're telling us to expect for the year ahead. You remember that earnings per share number from the beginning? The one they missed? Well, for a REIT, there's a way better number to look at. It's called Normalized Funds from Operations, or NFFO. It's basically the REIT equivalent of earnings, but it gives you a much truer picture of the cash their properties are actually making. This is the one that really counts. And this is where it all comes together. In 2025, they brought in $1.72 per share in NFO. But for 2026, they're guiding for somewhere around $2 a share. That's another year of, you guessed it, double-digit growth in the metric that actually matters. And what's going to fuel that growth? Well, it's their superstar players. They're expecting their shop and Trilogy segments to just keep on crushing it in 2026 with more fantastic growth. It's clear they're planning to ride this wave of momentum. I love this quote from their COO, Gabe Wilhite. He says, they're focused and steadfast on establishing best-in-class revenue management. What that really means is they're not getting complacent. They know it's working, and their entire focus is on execution and just getting better and better at it. So we've come full circle. That headline miss that seemed so bad at the beginning, turns out it was just noise. The real story is so much more exciting. It's about a company with incredibly strong operations, a smart plan for the future, and a ton of confidence. And it really makes you wonder, with a foundation this strong, is AHR's real story just getting started? And there you have it. That's the story behind the numbers for American Healthcare REIT. Thanks for digging into it with me.